Everyone talks about volatility like it's a monster under the bed. Can you break it down for us?
The probability of being in a loss gets lower and lower as you increase your time horizon. Gold has a negative correlation. When stocks go down, gold tends to sort of go up. While Indian equities is a great asset class, it is not the only asset class that deserves a position in your portfolio. We recommend people take slightly higher risk assets. The more complex the product, the more likely that the manufacturer is going to make more money than the investor. The smartest investors, they all realize the role of luck. Most times, the final answer to the question is do nothing, stay the course.
Imagine this. The market crashes. Your portfolio is down 15%. What do? Panic, sell, or stay calm and ride the wave? Today's guest has spent over 2 decades as an analyst helping people make that call. So let's find out what he's learned. Welcome, Rinju. When the markets tank, what's the most common reaction you've seen from investors?
So, in my experience at least, the most common reaction I have seen people do is reach out to their advisor or somebody who understands the market and ask them for the reason for the particular fall. What people are actually trying to do is attribute a reason for that particular event. Markets will fall from time to time, markets will move in a direction that you may not understand. Speak to an advisor, speak to other investors, build a circle around yourself where you can understand the moves. Not every market move requires an action from the investor's perspective.
Why do you think people still get it wrong, even after going through past crashes?
The first thing that people need to understand before you enter an asset class is what to expect from the asset class. So look at Indian equities as an asset class, right? If you look at how it has panned over time. So let's say if you look at this chart, which has 20-year data, you'll see that there are 12 instances where the market has actually fallen 15% or more. Now, is 15% a crash? I would not call it a crash. I think it's what you would best term as a correction. Now, what is a crash? Now, in my view, something that falls maybe 30%, maybe 35%, that would be called a crash. And also, there's a function of how quickly it has fallen. So, if you understand the asset class that you're in, if your expectations are set, saying what has history been like, then you'll at least know what to expect out of that entire investing journey. The large caps will see a smaller correction during market trouble. The mid caps will see a deeper correction. The small caps will see a much deeper correction. But that is the nature of the segment itself, right? Because in an upward trajectory, the large caps will not go up as much as the mid caps or the small caps. So if you're going to participate in an asset class that gives you a significant return, expect the market corrections also to be commensurate to the returns that you are expecting.
Everyone talks about volatility like it's a monster under the bed. Can you break it down for us? What really is volatility? And should a long term investor be concerned about it?
Volatility for an investor is very different from what volatility for a trader or a speculator is. See, in the case of a speculator or a trader, volatility is a necessary condition. He will not be able to operate if there is no volatility. But it's a double edged sword, right? While you need volatility to actually position yourself for trade, it can also wipe you out if it's caught you on the wrong side. But an investor has to look at it very, very differently. For an investor who has a long investing horizon, as long as his investments are moving in the right direction, the short term volatility should not really matter. This reminds me of a story of a fund manager called Ralph Vanger. So, one of his memos, he writes about this uh, one particular dog owner who's walking from Columbus Circle to the Metropolitan Museum. Right, this is a 2.5 kilometer walk, and he decides to walk through Central Park. The dog is on a reasonably long leash, and the dog is full of energy. Right, so the dog keeps moving up, down, goes towards the bushes, goes towards the lamppost, and everybody's focusing on the dog. But as a long-term investor, you need to focus on which is the direction that the owner is taking the dog. Because see, the dog is going to go where the owner takes it. In the interim, it may move left, right, center, up and down. That is different. But as a long-term investor, what you are worried is, am I starting at point A? Am I heading in the right direction? Will I end at point B? So volatility to a long-term investor is very, very different. It is something that one should not worry too much about. Keep a track of how your portfolio is doing. Keep a track of how you are positioned. Focus on the big picture, which is, am I going from point A to point B? Is it in line with what I had planned? And am I achieving my goals?
The implication of what you said is that the shorter the investment horizon, the more volatility you'll experience.
That is true, right? So let's look at data, for example. So let's look at the past history. Let's focus on the recent past, right? So we'll take the last 5 years. I know the past 5 years include. So we're starting at March of 2020, which is the bottom of the crash. And it helps to take the last 5 years because it's been more or less a one way and upward sort of a trajectory. So for an average investor who came between the last 5 years, if your holding period was 1 year, so your return ranges could have been from anywhere from -6% to 81%. So the range is actually quite large, right? If you increase your holding period, so let's say you move that 1 year needle to a 2 year holding period, then the return range actually goes from 2% to 49%. So meaning that the probability of being in a loss gets lower and lower as you increase your time horizon. So just think of it. 1 year return ranges between -6 and 81%. 2 year returns between 2% and 49%. 3 year returns between 8 and 30%. So as you increase your time horizon, the return ranges also tend to start. So the returns start becoming a lot more predictable. That's the advantage of having long-term investing as your time horizon.
Let's say someone's portfolio went down by 15% and they're stressed. So, what's your advice on what they should not be doing?
And if your portfolio is down 15% and if you're stressed, then you've got yourself into the wrong asset classes, right? Like I said, Indian equities over the long term, let's say you take a 20-year history, there have been 12 instances where the portfolio is below 15%. That should not get you stressed. If it gets you stressed, then Indian equities is not the asset class for you. So if a 15% drawdown starts causing stress, relook at what your asset allocation is. Speak to an advisor, do a risk profile, see if you're in the right asset mix. On the flip side, try and control your behavior, right? Stay the course. Forget on if you have a long investing horizon, forget what is happening in the interim. Continue, stay the course. Periodically review the portfolio to see if you're still on track, but don't let these market corrections sort of intervene with your journey.
You had mentioned earlier that you actually want some of your customers to go through a bear market run. So, do you actually see?
What
Do
I
you
find,
actually? So, do you actually see market dips as an opportunity?
so if you're in the initial stages of your investment journey, then we would recommend that you look at opportunities, market dips as opportunities to accumulate more. So for example, in the recent past, when we saw a sudden correction in the market, we asked people who had scheduled investments for them, saying, can you advance maybe one or two of your next scheduled investments, because we were of the view that this is a good opportunity, right? So if you look at the recent past, the market hit a 15% drawdown and then had a sudden pullback. So there are levels at which we ask people, if you have money waiting on the sidelines, use these dips as opportunities, but that is restricted primarily to investors with a much longer time horizon.
And if someone wants to crisis proof their portfolio, where do they even begin?
See, I'll always recommend that you start with understanding what asset classes you're in. Once you've got your expectations set, that should sort of give you a lot of cushion in terms of crisis proofing your portfolio. The second thing we recommend at Scripbox is that you have an asset allocated portfolio. See, while Indian equities is a great asset class, it is not the only asset class that deserves a position in your portfolio. So, over the long run, Indian equities should have a 12% plus or minus 2% return profile. But during drawdowns, Indian equities has a much higher drawdown. Say, for example, during the 2008 crisis, I remember the large cap index was down 65%, right? So having a bit of gold into your portfolio, while the reality is having a little bit of gold in your portfolio will always help, because gold, for one, has a negative correlation, meaning that when Indian equities does well, gold will not necessarily do as well. But when stocks go down, gold tends to sort of go up. So it's inversely correlated. And what that does is it gives your portfolio a decent performance across time. The third thing that I would recommend people start looking at when you're talking about crisis proofing your portfolio is build a diversified portfolio. See, having too much focus on one single stock or one single sector will keep your portfolio open to the vagaries of that particular asset. Have a diversified portfolio. So if in your portfolio, if you're buying stocks, for example, have some banks, have some FMCG companies, have some manufacturing companies. So that allows your portfolio to be sort of de-risked. The alternative is to go through the mutual fund route, where you're asking a fund manager, you're getting the best of minds to make your portfolio So go with diversified funds. There are plenty of options available there.
And how does your advice change when it's someone in their 30s compared to someone who's say 55?
Typically, what changes is in your 30s, you're at the starting stage, you're at the accumulation stage of your investing journey. At 55, you're closer towards the withdrawal stage. So, in your accumulation stage, you have a long runway, right? When you have a long runway, then we recommend people take slightly higher risk assets. So, the allocation to a risk asset like an equity or gold could be slightly higher than what we would recommend allocated to debt funds. But as you are closer to your withdrawal stage in life, we recommend having a lesser allocation to the risk assets. So the asset allocation would change. The principles will remain the same, that you always have to have an asset allocated portfolio. But how much you weigh each asset within that particular portfolio will change depending on age. It is also a question of depending on where you are on the wealth stage and how much your withdrawal plans are.
With so many financial products out there, like rates, cryptos, FNOs, do you sometimes think simpler is better?
It's not sometimes, and actually the reality is in most cases simpler is better. Okay. Now, I've studied financial products for 20 years now. At least what I have understood so far is that the more complex the product, the more likely that the manufacturer is going to make more money than the investor. So we recommend that you look at products that are simple to understand. If you cannot explain this to your 10-year-old child, then there is no merit in you investing in that product. Look at mutual funds, for example. Such a wonderful product. You can invest small amounts, you can withdraw small amounts. Taxation is only when you withdraw from the fund. You get access to great management. Like, think about it, the smartest people managing your money for a small fee of 1.5%. There is no better product. And it's quite straightforward. It's quite simple, right? There's a fund manager who's an expert at doing his job. You're giving your money, asking him to do it for you. And this is at a small fee. It's a simple product. I always recommend stick with the simpler products because there is merit in simplicity.
And how do you personally help your clients like block out financial noise and keep them focused?
As an advisor, we try to focus on what is important. So we have this way we approach communicating events to clients. The first thing is the event material, right? So we don't communicate every day. There are only points at which there requires communication. So we limit it to a period, probably once a week, maybe once in 2 weeks. That is a preferred frequency of communication. We try and tell customers what is the event, what does that really mean, how does that impact the client's portfolio, and in this context, what should the client do? And the funny part, Anand, is most times the final answer to the question is do nothing, stay the course.
Do you recommend any habits to avoid emotional investing?
So the first one I do first is don't look at your portfolio on a daily basis. Periodically review your portfolio. You don't have to look at it daily basis. Nothing is going to change, right? It's going to move a little bit up, a little bit down. Don't get stressed about that. Second thing is get an advisor. Third is try and create a circle around yourself, right? There are self-help groups for everything. Why not for investing? Try and create a circle of friends, people who have common interests, where you can bounce off ideas, understand what their thinking is. Because typically, when you get into an activity on your own, you tend to have your own biases. Get people who you can trust. Get their frank opinions. See if you're getting biased. See if you're acting in the right.
So, what should someone look for in a professional or a financial advisor, like beyond just returns?
Start with an advisor who has his incentives lined with your outcomes, right? Look for somebody who actually takes ownership for what outcome he brings to you. Second thing is we recommend you look at an institution. See, what happens with individual financial advisors is that he might be a great person, but what if he decides to stop uh, his advisory practice or so? Look for a institution to manage your money. And the third thing is it helps to have an institution where there's a data driven approach, where there is continuity of practices and people who are willing to change their minds. Like, let me give you an example. Uh, 6 years ago, probably I was not a big fan of having gold in the portfolio. But when we started looking at the data more closely, we realized what benefit gold brought into the portfolio. So then we changed our stand. Some great investor once said, uh, when I see data that contradicts my view, I change my view. What do you do?
And what are the red flags people should be watching out for when they are seeking investment advice?
Anybody who guarantees you a return that is outside of the fixed income universe, that's a huge red flag. See, because most people will tell you it's a game of probabilities. There's a possibility of a return. Okay, there are ranges where you can expect. It is not certain. So, like for example, when I talk about returns on Indian equities, I tell people it's a 12% plus or minus 2 if you have a 10-year holding period, right? So, what does it say? It says that you have to have X in terms of your longevity for the investment. Second is the average return is there, and there is a range where you will find the returns lie. So that's the right way to look at it. Somebody who just promises you 15% return, that's not going to, that's a big red flag for me. The second thing is somebody who's very aggressive, somebody who does not look at risk management as a core tenet of personal finance. I think that is a big red flag for me. So when people talk about returns, I'll also look for what are the expectations in terms of drawdowns or what is the risk associated with that return.
And what's one thing the smartest investors you worked with consistently do differently?
Smartest investors I've gotten to know so far, one thing I've realized is they're really intelligent, and this is what they do full time, right? This is not a part time job for them. The second thing is they all realize the role of luck. So you speak to the smartest investors, they will tell you, listen, expect a certain amount of decisions that you make to go wrong. There is an element of luck there. The third thing is they understand it's a game of probabilities and they play it that way. So one more thing is that most of the smartest investors, they have moderate expectations. They're not people who are trying to shoot the lights out. They try to get a decent outcome, and the way they approach it, they could probably shoot the lights out, right? So this moderation of expectations is a great thing to have because that makes sure that you're not stretching yourself beyond what you call as your circle of competence.
Thank you, Rinju, for joining us today.
Thank you for having me.
If you found today's conversation valuable and want advice tailored to your financial goal, book a free session with a Scripbox expert. It's quick, easy, and built around your goals. You'll find the link in the description below. We look forward to helping you make smarter money decisions.